Welcome back to another episode of Cash Flow with JVH. Today we're going to discuss candlesticks and top 12 candlestick patterns that you should be aware of if you are trading on the stock market. As always, if you enjoyed this video, give me a thumbs up. Be sure to subscribe to the channel and share this channel out with your family and friends on all your social media networks. Okay, so the first question you're probably asking yourself is, what is a candlestick? Well, a candlestick is actually a way of displaying information about an asset's price movement. So candlestick charts are one of the most popular components of technical analysis, which enables traders to interpret price information quickly and from just only a few, price bars. But before we get into what the candlestick patterns are, let's go through a quick explanation of what the components of a candlestick are. So we actually see two candlesticks, right? And just for basic demonstration purposes, we're going to explain a few different elements of it. So the first element would be the body, and that's this piece and this piece right here. Now the body actually represents the open to close range for that specific time period. Now that could be every minute, that could be every 5 minutes, it could be every hour, or even every day, right? Depending on the scale or time frame that you are looking at your specific stock charts. The second piece is called the wick, and that would be this. So, right? So just like a candle, it has a body, which is the wax, and then the wick, which is the little string. So the wick, or sometimes also known as the shadow, that indicates the intraday highs and lows. So even though it may have closed here, it actually got as high as there. And then the third element to the candlestick is called the color. This actually reveals the direction of the market movement. So a green, right, on the right-hand side here, also sometimes you will see this displayed in the color of white. The body for that indicates a price increase. So it opened down here and it closed up there. While a red, or sometimes displayed as black, body shows a price decrease. So you can see the market opened here and then dropped all the way down to here. So now we'll actually go through 6 bullish candlestick patterns, and then we'll go through 6 bearish candlestick patterns. So the first bullish candlestick pattern that we're going to go through is called the hammer. Now the hammer candlestick pattern is formed of a short body with a long lower wick, as you can see right here, and is usually found at the bottom of a downward trend. Now, the hammer shows that although there were selling pressures during the day, ultimately a strong buying pressure drove the price back up. The color of the body can vary, but the green hammers indicate a strong bull market rather than red hammers. The second bullish candlestick pattern is called the inverse hammer. It's similar to the inverted hammer, the only difference being that the upper wick is long. So you can see the upper wick here is long, while the lower wick is short. It indicates a buying pressure followed by a selling pressure that was not strong enough to drive the market price down. So the inverse hammer suggests that buyers will soon have control of the market. The third bullish candlestick pattern is called bullish engulfing. Now, the bullish engulfing pattern is actually formed by 2 candlesticks that you can see down here at the bottom. The first candle is a short red body that is completely engulfed by a larger green candle. Though the second day opens lower than the first, the bullish market is pushing the price up, which is culminating in an obvious win for the buyers. The fourth bullish candlestick pattern is called the piercing line. Now, the piercing line is also a 2-stick pattern, but it's made up of a long red candle followed by a long green candle, and there is usually a significant gap down between the first candlestick's closing price and the green candlestick's opening. This would indicate a strong buying pressure as the price is pushed up to or above the mid price of the previous day. So here you can see the close and then the open, and there's that gap between them. The fifth bullish candlestick pattern is called the morning star. Now, the morning star candlestick pattern is considered a high sign of hope in a bleak market downtrend. So it is a 3-stick pattern, one short-bodied candle between a long red and a long green. Now, traditionally, right, so here you see the morning star pattern. Traditionally, the star will have no overlap with the longer bodies. So you can see here, there's really no overlap there. As the market gaps both on open and close, it signals that the selling pressure of the first day is subsiding and the bull market is on the horizon. So generally a potential direction of uptrend. Now, the last bullish candlestick pattern we're going to look at is called the 3 white soldiers. The 3 white, and again, it's called the 3 white soldiers because generally on candlestick pattern charts, when you're either looking at green or white. So in this case, the candlesticks are green, but they could also be white. So it consists of 3 long green or white candlesticks with small wicks, which open and close progressively higher than the previous day. It is a very strong bullish signal that occurs after a downtrend, and then it shows a steady advance of buying pressure. So here we can see that really strong downtrend, but then we see the 3 white or green soldiers forming an uptrend with small wicks and again progressively increasing. Now let's take a look at 6 bearish candlestick patterns. So the first bearish candlestick pattern we're going to look at is called the hanging man. Now, the hanging man is the bearish equivalent of the hammer, which was the first one we went over in our bullish candlestick patterns. It has the same shape but forms at the end of an uptrend. So here we can see the uptrend, but now we see the opposite of the hammer, which would typically be here, right? But now it's up here, and it's going to potentially have the direction of going down. It indicates that there was a significant sell-off during the day, but that the buyers were able to push the price up again. The large sell-off is often seen as an indication that the bulls are losing control of the market. The second bearish candlestick pattern we're going to look at is called the shooting star. Now, the shooting star is the same shape as the inverted hammer, but it's formed in an uptrend. It has a small lower body and a long upper wick. Usually, the market will gap slightly higher on opening and rally to an intraday high before closing at a price just above the open. So it's sort of like falling, like a star falling to the ground, if you will. So here we see the uptrend, here we see the shooting star, and then potential direction going back down. The third bearish candlestick pattern we're going to look at is called bearish engulfing, just kind of the opposite of bullish engulfing. So a bearish engulfing pattern occurs at the end of an uptrend, right? So we have the uptrend here. We see these 2 candlestick patterns. The first candlestick has a small green body that is engulfed by a subsequent long red candle. So we see the green bodies here, and this red candlestick is engulfing that. It signifies a peak or slowdown of price movement and is a sign of an impending market downturn. So the lower the second candle goes, the more significant the trend is likely to be. The fourth bearish candlestick pattern we're going to look at is called the evening star. So as you probably guessed, the evening star is a 3 candlestick pattern that is the equivalent of the bullish morning star. It is formed of a short candle sandwiched between a long green candle and a large red candlestick. So here we have the uptrend, we have the long green candle, the long red candle, and then right in the middle is the short candle. It indicates a reversal of an uptrend, which we saw here, and a particularly strong when the third candlestick erases the gains of the first candle. The fifth bearish candlestick pattern we're going to look at is called Three Black Crows. The Three Black Crows candlestick pattern comprises of three consecutive long red candles with short or even non-existent wicks. So here we can see the three candles and very, very short wicks. Each session opens at a similar price to the previous day, but selling pressures push the price lower and lower with each closing day. So traders interpret this pattern as the start of a bearish downtrend, as the sellers have overtaken the buyers during 3 successive trading days. And then finally, the sixth bearish candlestick pattern is called the dark cloud cover. Now, the dark cloud cover candlestick pattern indicates a bearish reversal, a black cloud over the previous day's optimism. So it comprises two candlesticks, right? So you see here, a red candlestick which opens above the previous green body and closes below its midpoint. You see the opening, and then here would be the midpoint, and it's closing below that. It signals that the bears have taken over the session, pushing the price sharply lower. If the wicks of the candles are short, it suggests that the downtrend was extremely decisive. So there you have it. We have talked about what candlestick patterns are, what a candlestick is comprised of, and then we took a look at 6 bullish candlestick patterns and 6 bearish candlestick patterns. I hope this video was helpful. Again, make sure you like my video, subscribe to my channel, and share this channel out with all of your friends and family across all of your social media networks. For Cashflow with JVH, have a great day.